Thank you for joining us for today's Ipsos webinar, Exploring the Future of Financial Services. Throughout today's session, you will remain in listen-only mode. However, throughout the webinar, you may submit questions online using the Q&A feature located on the right side of your screen. Time permitting, we'll answer questions at the end of today's session. However, if time runs short, then your question will be answered by email. Today's webinar is also being recorded and will be posted to our website within about 48 hours. Now, without further ado, it is my pleasure to introduce today's moderator, Oscar Yoon, President of Ipsos Strategy 3. Oscar, you have the floor.
Thanks very much, Ellen, and good afternoon, everyone. I want to thank you all for joining us today on the line for WTF Finance. For today, WTF stands for What the Future, not whatever else you might think it is. WTF What the Future is a series that Ipsos puts out where we examine the future of specific industries that are important and relevant to consumers today, to businesses today, and of course to our economy. Over the past year, we've examined things like the future of mobility, the future of food, the future of beauty, the future of housing, amongst others. And as you know, today we'll be focusing on the future of finance and of financial services. Timely discussion, of course, given the situation we're in with the COVID-19 pandemic. As we know, we face potentially what is the worst recession or depression in generations. So I'm sure it'll be a lively and interesting discussion. But before we get going, I want to invite those of you who are listening in to submit questions via the question box in the middle of the screen. We'll do our best to answer all of them, and we'll have all the questions as well that you have submitted in advance, those of you that submitted questions in advance. And those questions we don't get to today in the session, we'll follow up with you separately afterwards. So as Ellen said, my name is Oscar Yoon, and I lead Ipsos Strategy 3. We are the strategy, trends, and future consultancy here at Ipsos. So this is a feature that we put out quarterly. And I think, as I said today, focusing on the idea of what the future of finance, really, really timely. Just a recent poll coming out, from last week. Americans are facing an unprecedented economic challenge. I don't think that's news to anyone if you've been watching what's going on in the world around you. We see, the unemployment numbers reaching upwards of 20%, depending on your demographic profile. I think we're seeing this impacting younger workers more than older workers. But regardless, I think on average we're seeing unemployment numbers hitting, as we've heard many times, levels that we haven't seen since the Great Depression, right? Almost 100 years ago. And this is not just for people who are working, but also people who have lost, who have people in their household who are losing their jobs as well. And so the scale and scope of this crisis is really unprecedented, to use a word that's overly used these days. But beyond economics, I think we're also facing a crisis of consumer confidence, right? So as you know, the two are closely linked, right? And the survey that we recently came out with is almost half of adults are worried that someone in their household will lose their job if there's another lockdown. And almost half are worried that there's going to be another lockdown this fall. And what we're seeing from an epidemiological perspective is that probably a likely scenario. So there's going to be some unstable times looking forward. And I think it's a culmination not just of what's happening in the world around us, but a culmination of all the things and trends we've been seeing in the past decades, right? So the real income growth for the top 20% of households has been 14% since 2008, and compare that to decline in the real income income growth for households in the bottom 20%. So we're seeing an increasing divide in our economy that I think is only exacerbated by what we're seeing happening in the world around us. So I think all topics for discussion today. And really, given this context, the question we want to answer today is, what do we envision the future of consumer finance, the future of the financial services industry? What do we envision that's going to look like? And so to help us answer that question, we have a fantastic panel today. I want to introduce you to each of them. Christine Parler is the Solvency Coleman Chair of Finance and Accounting at the University of California, Berkeley's Haas School of Business. She does a lot of work in institutionally complex areas such as market microstructure and banking. Her current work focuses on changes in the payment system and the effects on banks' balance sheets. So besides writing for major finance economics journals, we're lucky to have her here today, Christine. Second, we have Jennifer Tescher. She's the founder, president, and chief executive officer of the Financial Health Network, the nation's authority to improve the financial health of all. The organization has invested in more than 40 fintech innovators who are developing solutions to critical financial health challenges. Jennifer has also served on the boards of several financial organizations, including the Federal Reserve Board's Consumer Advisory Council and the Fannie Mae Affordable Housing Advisory Council. Thank you, Jennifer, and we're glad you're here. We also have Jason Brown with us. Jason Brown is a Chief Client Officer for Ipsos here in the U.S. Since March 2019, he's been leading client accounts in financial services, fintech, and consumer health companies. Prior to this role, he's held several executive positions in his 20 years at Ipsos, leading both innovation and brand practices focused on services and tech industries. Thank you, Jason, for joining us today. And then finally, I want to welcome Susan Peters. I think Susan's having a bit of a problem with her camera today, so we can't see her, but I know we can hear her. Susan Peters is the Managing Director at Bank of America. She's leading strategic initiatives within the Marketing Research and Insights organization. So in addition to leading the bank's efforts on segmentation, customer behavior change, customer journey, life cycle, competitive intelligence, and foresight and trend monitoring, for the past 8 weeks, she's been leading the research team's efforts around COVID-19. So I think well suited for our conversation today. So as we get going, Christine, I just want to start with you and first apologize. I see we're missing a T in your on the page up there, but apologies for that, Christine. I want to ask you, as someone who studies financial institutions, what role or what responsibility do you think financial institutions have or can play in our economic recovery? You know, whether that's around stimulus, whether that's around how they can cooperate with government, how they work with consumers. But talk to us a little bit about what role do you think financial institutions can play? You know, we've seen a lot from the government, less from financial institutions so far.
I think financial institutions are going to play a huge role. I mean, a lot of it has to do with what they do. So banks historically have taken capital from those who have it and allocated it to those who haven't. They have the infrastructure and they have the capability to do that. And so given the huge demand shock that we've seen and the sort of massive loss of revenue during the shelter-in-place, banks in particular are well positioned to provide people liquidity going forward. The thing that's going to be a little bit complicated is that the world has changed. So what was true about pricing credit risk and assessing risk yesterday is not going to be true about pricing credit risk and assessing default risk, if you will, going forward. That means that there's also room for people who use slightly more, let's just say, innovative and different ways of assessing risk and what has changed, because they will be able to essentially give capital or provide capital to people who are going to thrive in the new environment as opposed to people who thrived in the old environment. So we're definitely going to see a change, and this is something that financial institutions have to spend a lot of time thinking about, how they're going to price risk going forward.
And given the fact that there's a lot more, you know, work to be done in terms of pricing risk, are we headed towards a world in which we could be headed towards, unfortunately, another 2008, you know, in which the many risk products were not properly assessed or priced? What's your assessment on that?
I mean, I think that any risk-based instruments that were issued pre-pandemic are essentially have just had a dramatic loss in value. So the question is, who's holding them on their balance sheet and what effect is that going to have on their ability to make loans going forward? This is something that we don't know yet and is going to play out. I think it's pretty clear from the actions that the Federal Reserve has taken that they're going to be extremely aggressive in making sure that those kinds of losses are not going to hold people back.
There's plenty of other stuff that will hold people back, but it's not going to be those things.
Sure. And Jason, what's your perspective on how consumers feel about financial institutions these days, right? I think there was a lot of noise, through the distribution of the PPP loans and a lot of the recent financial, that there's skepticism and anger with financial institutions, but in fact, consumers do need to work closely with the banks to get through this. What have you seen or heard in terms of consumer response to financial institutions as we kind of go through this crisis?
Well, I'll set the PPP aside and come back to that. In terms of general consumer sentiment towards banks, we've actually seen an increase in trust for financial institutions, at least so far. So more people are saying that they trust financial institutions more than are saying they trust them less as a function of response to the crisis. On the PPP, it's a little different on the small business side. It's a tough time for small businesses. And the PPP distributions were a Herculean task, right? I mean, amazing. But it's also a thankless task. And because you've inherited a relatively thankless task to try to keep as many people solvent as possible on the small business side, there's work to be done to improve there.
And so do you think that was an anomaly in kind of as we go through this and how people feel about financial institutions?
Well, I think small businesses will feel a certain way for a while, and trust will have to be re-earned, and small businesses will have challenges going forward. The general consumer sentiment towards banks, though, is positive right now.
That's good. And I guess that leads naturally, Susan, to you. Can you tell me a little bit about, what banks, your bank perhaps, what banks are doing to support their customers through this time?
Sure. Thank you, Oscar. And I apologize for being kind of like the Wizard of Oz behind the curtain here. We talk about the trend to nostalgia, and so Wizard of Oz comes to mind. But yes, in terms of support, obviously, hopefully that trust and that confidence as we see that return in terms of the focus on customer needs. And those needs being needing to stay safe and secure and financially stable. So obviously the more the here and the now, not so much as we're talking about the future, but the here and now, and helping customers make ends meet, pay their bills, give access to credit, help with their cash flow. So that's all about waiving fees and deferring payments and keeping them safe. And as we think about the fear and anxiety brought on by the rapid spread of COVID and the change in overall consumer mindset and psychology, and the impact that had on the in-person experience and social distancing and all of that. And so I think from a customer needs perspective, it's pretty clear what we have to do to help, and why there's been a rapid acceleration in terms of the way that people bank and the way they need to access their that interaction. So I think across generations, we've seen that acceleration. That move to mobile wallet and contactless payment methods, which we're supporting them through the pandemic, and really trying to make the lowest friction experience, which is, it's becoming increasingly important through the crisis, that we expedite that and think about how banking fits into someone's life overall.
Yeah, thank you. And have you seen, from your perspective, where you sit, how has consumer financial behavior changed in the past 3 months, right? 4 months. Do you have any sense of kind of what are you seeing from your perspective?
Well, from there's the obvious in terms of the desire for savings, where we would have seen increased savings and saving for emergency, and the need to access credit. And what we would have seen in terms of refinancing and home purchasing and all the things that are going on hold, the protecting against losses. So I think I'm probably stating the obvious there in terms of what we've seen from a financial behavior standpoint.
And anything surprise you as we've gone through this?
Well, I think as we're looking to continue to provide financial advice and guidance and education around financial health and education around digital tools, and I think just all of the uncertainty and the unknown as to where to turn to for that. And I think the increasing sentiment of people becoming more aware of the need for a financial plan and the need for a budget. So again, I don't think that's an aha or surprise, but a trend.
No, it's interesting you talk about, financial planning and putting together forward-looking, forecasts on what we should do. One thing that is becoming apparent through this pandemic is how it's really affecting different groups within our society differently, right? We hear a lot in the news about how certain groups, perhaps the more socioeconomically advantaged, have the luxury to socially distance and the ability to work from home and the ability to be on Zoom calls all day long, right? Where certain other parts of our society don't. They need to go to work. They need to generate income. And so, maybe Jennifer, you can talk to us a little bit about what is the inequality in our company, in our economy that you study? How has that been exacerbated, and how do you think we can address this going forward? And are there any areas that you think are quick wins that we can think about as we go through this?
Well, I think it's important to remember that these inequities existed long before COVID, and they're systemic. In some cases dating back a few decades, and in other cases, particularly around race and ethnicity, dating back hundreds of years. We study the financial health of people in America. We do an annual survey. It's longitudinal, so we're able to see the same people year on year. And just to put this in context, as of 2019, only 29% of Americans would we consider financially healthy based on our measurement framework. 54% were coping and 17% were financially vulnerable. And if you break out those numbers by race, ethnicity, by income, by gender, they are skewed in the ways you would expect. And that was pre-COVID. We've just literally come out of the field with the 2020 numbers about a week ago. And because we knew we were going to be in the field, we were able to add in a whole host of other COVID-related questions. What we found is that, and this is about a 5,000 or 6,000 person nationally representative sample, and what we found is that about a third of them had lost their jobs or lost income because of reduced hours. And the analysis that we're in the process of doing, there's about 1,000 people, is to look at the financial health of that group, because some people have lost hours or lost their jobs and are still relatively financially stable, and others are not. And we're doing an analysis to really understand what moves the needle. I can tell you from our previous work that changes in employment cause the largest average year-on-year changes in financial health, and after that, it would be changes in physical health. And that doesn't really bode well, given the fact that in this pandemic, we're facing this 1-2 punch of physical maladies along with financial dislocation. I think one of the other concerns that I have is around this acceleration to digital. On the one hand, it's fantastic, but on the other hand, it's going to widen the chasm that already exists between the digital haves and have-nots. So, we tend to think that the digital divide has gone away because everyone has one of these, in their pocket. And it's true, cell phone usage, ownership, and even smartphone usage is pretty high. But as you can see now from the stay-at-home orders, the real issue is, do you have broadband? Can you get on the internet? Because when the public library is closed and your school is closed, and maybe you got on at work and you're not going to work, you can't get online, or you're getting online with very, very scarce cell phone minutes that you're paying for as you go. And if you think about it, a lot of the PPP, the EIP aid, the needing to tell the IRS your bank and routing number in order to get the stimulus check directly deposited, assuming you have a bank account, all of those things need to be done electronically. Filing for unemployment insurance. So if you're lacking from a digital perspective, you're being doubly hurt.
Yeah. I mean, it's unfortunate. Maybe for the group, how do we think about what this crisis, what the impact is on specific financial services products? So let's say insurance, right? On the one hand, you would think that at a time like this, interest insurance would be going up, but of course that costs money. So if we can maybe just go through a couple financial services products, since I know many of the listeners today are from different areas within the financial services industry. What's your perspective on insurance and how insurance is going to be impacted by what's happening? Anyone?
Go ahead. I think.
No, go ahead, Christine, and then Jason. Let's do that.
So if I could just jump in a little bit. So one of the things that insurance companies do is that they hold a lot of fixed income instruments on their balance sheets, just because of the nature of the business. If it is in fact the case that they're holding a lot of fixed income instruments whose value has declined, essentially because of unanticipated increases in defaults, or they're sort of closer to sort of default boundaries, essentially that means that their balance sheets are weakened. What typically that happens in terms of the pricing of consumer insurance products is that they increase prices, or they change prices in a way that's going to help them get their balance sheets back to health. So this is almost just a mechanical thing that happens when insurance companies think they need a little bit more cash on hand. They affect pricing. So irrespective of whether or not it's now more difficult to assess risk, it's now more difficult to sort of figure out what's going to happen, and so price risk, there's just going to be this mechanical increase in the prices of insurance products just because this is how insurance companies work. So this is something that I think we should all be aware of.
Interesting. And so, and we've all seen the ads that the auto insurance companies are giving back people money because they're essentially not driving, right? So would you say that a lot of the industry is acting in short-term consumer-first behavior, or what's going on kind of with what's been happening there?
I think a lot of the how insurance companies operate depends on exactly how many lines of business they're in, right? So if you have an insurance company that's only one line of business and wants to keep those businesses, then they might have a slightly different pricing strategy than an insurance company that's essentially multi-line. And so, but overall, if you have a multi-line and a monoline who are providing the same sorts of insurance, and one of them increases their prices, well, the other price is going to drift up. So yes, you might see some very sort of short-term incentive types of things, and oh, let's be nice and let's make sure that people don't cancel their policies because they're not driving, right? But longer term, this is something to think about.
And Oscar, if I could just weigh in real quick before Jason. I agree completely with what Christine said, but I also think that the place where you're seeing this play out first is in life insurance. It's getting increasingly difficult now to get life insurance. Prices are going up. The underwriting is becoming more stringent. Whereas in the P&C market, this is not a natural disaster where we've had, say, a hurricane or a tornado or flooding, and the insurance companies are seeing lots of claims. If anything, they're seeing no claims because no one's driving and getting into car accidents, that kind of thing.
Yeah.
But life insurance is a whole different matter. I think you're right to pick up on the issue of insurance, because at the end of the day, this pandemic demonstrate is an exercise in black swans and risk management. Nobody except for the top 1%, maybe the top 5%, could weather this without any impact, has a big enough cushion to weather this kind of economic fallout. The statistic that about 40% of people in America couldn't come up with $400 in cash for an emergency, that's really important, but it's irrelevant in a situation like this where $400 is going to last you, a few weeks at best. And I think there's going to be a lot of opportunities, both from a social insurance perspective and in the private markets, to really think differently about what kind of buffers we can create for households for more of these black swan events, which unfortunately I don't think are going to be black swans anymore. It's like the 100-year flood that's not 100 years anymore because of climate change. So I think the connection back to climate change here is really important.
Yeah. But Jason, you were going to say something on insurance.
Yeah, on the property and casualty side, I think an interesting thing to watch will be the migration of people. And this crisis is very geosensitive in the U.S. to cities and to towns. And I do think that we'll see, because of unemployment, because of fears of the disease, that there'll be more movement away from urban centers. And so, the risk profile as people cluster in different places is going to change maybe in a year's time. So how you think about risk will change, and it'll be highly geospecific, much more than it is, and it'll be different than the geospecificity from 3 months ago.
Interesting. Let's talk briefly about retirement, right? So what is, and maybe Susan, I know part of Bank of America, you guys have Merrill Lynch and a good number of investment pieces of the organization as well. What do you think, what do you suppose is going to happen in the savings, retirement, 401k space? Susan, did we lose you? I'm gonna ask someone else. Maybe Jason, what do you think on the 401k kind of savings space?
In the savings space, so traditional savings, because rates are low, are going to be less attractive. So the life insurance, annuities, traditional savings aren't going to be attractive. I don't know what's going to replace that. So kind of the risk-adjusted 401k portfolios and invested portfolios are going to look very different. I also think that if this drags on much longer, that the traditional valuations of securities is possibly going to change. The kind of net present value and the traditional metrics will always be important, of course, but what the companies are doing for social good, sustainability efforts, corporate social responsibility, those things I think might get woven into valuation in a different way. And so I do think people that are thinking about investments, retirements, or otherwise need to think about valuations differently going forward.
Christine, any thoughts on savings, 401k investments?
Oh, excuse me. One of the things that we should be aware of is the relationship between workers and firms is probably going to change going forward. So whether or not we see more people working on a contract or hourly basis as opposed to actually having an employment relationship with a firm, we're probably going to see more of that. To some extent, the shelter in place that we've experienced is almost like a test to see whether or not we can do that or how that works. And with the massive layoffs that we're seeing, a lot of people won't be coming back. What that means is it means that people will be responsible for their future savings and retirements. There'll be less incentives and less sort of co-pays with companies. And I think the sort of the longevity risk that we talk about and the lack of retirement is probably going to just get worse and worse and worse and worse. So I think this is, I mean, to some extent we're focused on the here and now, but long term, it's a social problem, and I think it's something that I think the country will have to tackle after we've got through what is going to be a horrendous sort of 8 months at least in front of us.
Mm-hmm. I know part of what we're seeing now is a lot of defaults on mortgage payments. People aren't able to make their monthlies. Maybe we touched briefly on what we think the future of mortgages, home ownership, what that sector looks like. Jennifer, do you want to start there?
Sure. I think you can't have this conversation without starting back in 2008. The financial crisis, the last one, was driven by subprime mortgages and by an entire system out of whack. But the result of that crisis was a dramatic reduction in home ownership rates as people lost their homes through foreclosure, and that was particularly true of low and moderate income borrowers and borrowers of color. And we have not regained there at all for a variety of reasons, including the fact that home prices, particularly on the coast and in other major markets, are absolutely out of whack. So people are paying, whether they're a homeowner or even a renter, are paying massive percentage of their incomes towards housing, which is yet another piece to this puzzle of people's overall financial health. And I think that the nation has on and off again been having a conversation ever since 2008 about how important we think homeownership is as a national value. We certainly subsidize it, right, through the home mortgage interest deduction. It's something we pride ourselves on. We have very high rates of homeownership relative to other countries, but it is increasingly out of reach for a number of people. And I think that right now and for the next couple of years, all that we're going to be able to focus on is keeping people in their homes. In fact, I think that in a way, for the financial services industry, it may not feel like it, but this is really the calm before the storm, because financial services companies have had to do a tremendous amount to simply mobilize in the crisis to make sure they could satisfy demand, and particularly without physical branches. But a lot of people got forbearance on their mortgages and on other credit products. And that forbearance is going to come up, that 3-month period is going to come up here over the summer. And we're going to have to start making some very serious numbers of loan modifications. And that's when I think banks and other lenders are going to really feel the challenge. If you look at the data so far, defaults, delinquencies, charge-offs are not, we haven't seen a massive spike because of all of the forbearance. And so that's really what concerns me the most, is when we hit the summer and the fall. I think that's when we're going to start to see the big challenges.
If I could just jump in about the loan modification. So if you think about mortgages, if a consumer doesn't pay their mortgage payment because we want them to stay in their homes and we're worried about them losing their homes and so forth, it still means that the servicer who is in charge of handling that mortgage is responsible for paying what should have been the payment to the person who holds the underlying security. So essentially what we've done is we've shifted it from the individuals, and we certainly don't want them to lose their homes, onto the servicers. And the question is, do they have the capital buffer to roll out and to be able to cover those payments for the length of time that there is forbearance? It's unclear that that's the case. So this is something that Congress hasn't addressed and we haven't collectively addressed, but taking a debt that should have been paid and not paying it essentially means that somebody's holding the hot potato, and that's something that we should probably collectively be a little bit worried about.
Got it. So do you think the home ownership mortgage space is in for a big correction and will move towards a more highly rental society like Germany perhaps? Is that in the future?
I think it remains to be seen. I think it's too early to say. The fact is we have a desperate shortage of housing of all kinds, particularly rental housing, massive shortage of rental housing. So we have a housing stock problem. One interesting thing to think about is as you think about recovery and what the federal government is going to need to do ultimately from a policy perspective, you could imagine a major national effort to build back housing stock, both as a way to put people back to work and as a way to solve some of our other underlying problems. So I think if we think creatively, there are a lot of interesting things we could do. You know, I always believe never waste a good crisis, but I would say that Washington is just a little bit unpredictable right now, and until we get through November, I think I just don't think anyone can say where federal policy is ultimately going to go.
Fair enough. Fair enough. And maybe just one last kind of topic area when it comes to finance, and maybe Jason, you talk to this. Talk to us about what you think in the small and medium business world, right? We see a lot, obviously we see the collapse of that entire sector of our economy. Small, medium businesses are really suffering. They are, you know, they fuel so much of our economy. You know, is there going to be, what's your read on a comeback within the small and medium business community? How is that going to happen? What's your prognostication? Understanding that there's a prognostication on the small and medium business front.
Yeah, it's the statistics are jarring around it. We all know the unemployment statistics. About 56% of small businesses have indicated that they've closed permanently or they've reduced hours.
56,
about 30, 56, yeah. And work
wow.
we do for the work we do for a Chamber of Commerce through one of our clients. 30% of that is closed for good. So it's just, you know, it's staggering. So we know that, but another kind of nuance to it, and I referred to it a little bit around the insurance topic, is that we also have data that suggests that 7 to 8% of people have relocated in the last 8 weeks. So they've gone from where they live to somebody else, presumably as a function of unemployment. And 4 to 5% of people are living in newly reshaped households, which means they're moving back home. So these are mass exoduses of people and changes in living arrangements. So, you know, that's going to have huge it's a domino. It's going to have huge implications on commercial real estate valuation. On the one hand, in some cities and city centers, it might favor small businesses because commercial landowners need to find occupants. So people aren't going to be getting kicked out. So there's a factor that could help small businesses, and then there's another side of it where, you know, the companies that do have money that will snap up real estate. So we'll have this hodgepodge of chains and ma and pa shops in city centers and shuttered places. So that kind of migration, financial services companies really need to study that. And underemployment, which we talked about a little while ago, there's going to be a myriad types of underemployment in the future. So I think that's really important to understand.
Oh, great. I think we have 20 minutes left, and I know we're getting a bunch of questions in. So, you know, I think one thing we do want to think about is just as we go through this crisis, and we've talked a lot about different pieces of the financial services industry. I think, as we said in the beginning, you know, this recovery is going to be based as much on the acts of financial services industry as it is about the consumers and our trust in each other, in our economy, in what we're building together. So I think perhaps a good way to think about it is, you know, the future of financial services is really in an industry and companies built on trust. So let's think forward to that. I want to save some time at the end for questions. So of course, those of you that are on the line, please feel free to drop questions to the Q&A box. I think there's some interest in in the insurance industry. As I said, there's some participants who are from the insurance industry. We have a question around what trends are you hearing of or forecasting for the insurance industry? Obviously, we talked about returning premiums. Are there other things that you think are going to be part of the insurance industry? Kristen, you talked a little bit about repricing and reassessing risk. Are there other big things that are going to happen in insurance? Maybe, Christine, do you have any thoughts on that?
So I think one of the things that's very interesting about insurance is a lot of the slightly different and/or fintech models, right? So historically, insurance has been provided by people who have capital and insuring risk, so they're almost acting like a market. But we're getting these new models that sort of essentially either insurance based on how much you drive your car, or insurance based on certain activities, or insurance based on who your housemates are. So a lot of different models and different players essentially providing financial products. And a lot of it has to do with the amount of information that's out there. This sort of the digitization of a huge amount of stuff essentially means that new people can use information in different ways and provide new financial products. So I think we're going to see more of that. It's creative, and nobody quite knows where it's going, but it's very interesting.
Yeah. It's interesting. You talked about digitization, and that's such a hot topic right now, just not only just in terms of financial services, but in the way people are having to interact these days. We all see, Instacart taking off, and we see the use of video conferencing, of course, as we're doing today, taking off. How do you think digitization, and of course, within financial services, we're seeing contactless payments. Are there other areas in which digitization is going to change the industry, and perhaps this crisis has sped up? What about the use of cash or branch banking? Do we have any thoughts on how that's going to change and evolve? And maybe Susan, do you want to jump in there? Can we hear you, Susan? No, I think we may. I think we're having a little bit of problem with Susan's connection. Jason, what's your perspective on any other digitization future of financial services, whether that's payments, whether that's branch banking? How do those what's the future of that, right? Especially obviously Susan from Bank of America. I'm sure we have a lot of people on the line who come from large retail bank organizations. What do they have to look forward to?
Well, I think on the payment side, we know about 16% of people have tried a new contactless payment for the first time in the last 8 weeks. And they're probably going to keep on doing that. So I think the payments is kind of obvious. The barriers have been that using your phone, for instance, wasn't better enough than using a card. And now a card is going to become just another surface to have to handle. So I think that that threatens the plastic approach. I think that all of our financial products around payments will need to be more inextricably tied with budgeting, right? It can't just be a bank statement at the end of the month. So I think those companies that can connect banking and payments to budgeting, which represents an opportunity for the bigger technology companies. We talked about trust earlier, and by the way, people are trusting tech companies more in this crisis as well. So I think that connection to budgeting, I think branches are going to go away. I mean, commercial real estate is going to become an issue, and there'll be fewer branches. They'll be more controlled, but they will be where people need them. I think that's the point. I would see people, as we rebound a little bit, as they have more financial problems, they're going to want to go talk to people, right? Because they've been waiting on the hold line or on the customer service line forever. So I think we'll see this sort of spike of need, and there'll be a determination around where we really need banks to serve people where they are, so to speak, versus what could be replaced by digital. But I think a huge reduction there. I'll stop. I could go on.
Go ahead, Jennifer. Yeah.
I want to sort of reframe this part of the discussion because I feel like one of the challenges, I think, of the financial services industry is that it has always been a very product-centric industry. If I had a dollar for every time in the last decade some banker told me they were all of a sudden going to be more customer-centric, I wouldn't be on this call right now. Excuse me. And particularly in a moment like this, I think while I understand that we all have P&Ls to run and we all have responsibilities around various products and services, at the end of the day, we need to be thinking about what the customer wants and needs. And rarely does the customer express what they want and need in the terminology that we use. You don't really wake up one day and say, you know, gee, I think I'll open a checking account today, right? Or, oh yeah, today's the day I'm going to go, you know, check out that insurance policy. It doesn't work that way. And I think, if anything, this crisis demonstrates that what people want from their financial services company, they want to know that they have their back. They want to know that they're going to help them improve their financial health. Because banking and most of the products we're talking about, unfortunately, are commodities, whether they're offered by incumbents or startups. And there's certainly things we can do to improve the experience. And I think the experience is really what we need to be talking about. But I actually think that the whole basis for the relationship that we have with our customers needs to be around improving their financial life, improving their financial health. And then the products are there as the tools to support what folks need. That's a real flip for how this industry has long acted. But boy, wouldn't that be a great silver lining from this crisis? You know, one of the other interesting things that's happening is, and we've been, among other things, investors in the fintech space for quite some time, since before it was called fintech, is that a lot of the things that fintech companies have invented, different ways of thinking about the customer experience and around packaging value, are now all being copied in a good way, I believe, by incumbents. And now a lot of those fintech startups aren't going to make it, and they're going to ultimately be acquired by the incumbents. And so I think this may be a really interesting time where we might actually be able to get some kind of culture change among incumbents to be more customer focused, which tends to be a real hallmark of tech startups.
Sure. It's almost interesting, right? I like what you said earlier around, you know, never waste a good crisis, right? If you think about what happened after the Great Depression, is actually huge advances in the way our organizations are structured, in the social services that our government provides, in regulatory and controls that have allowed, you know, the U.S. to really prosper for the second half of the 20th century. So, you know, might this be an opportunity for that to happen here in this case as well? And Christine,
and I know
you're not.
We were talking. Oh, sorry. We were talking. Just let me make one more point. We were talking at the very beginning about trust, and Jason was saying that at the moment, like, you know, relatively speaking, things are good for financial services companies. But I do think it's worth pointing out that in the Edelman Trust Barometer, which they've been running for 20 years, banks are always among the absolute least trusted institutions in society. And they still are, despite having made significant improvements since 2008. And so we shouldn't overestimate the level of trust and comfort that people have for their financial providers.
I think, as we look ahead, one final kind of area I want to touch on briefly, and Christine, you might be the right person to speak to, what is the dialogue going on university campuses, Christine? What are people saying? What are people talking about? What do we think the next big frontiers are? Obviously, we know about fintech, but where's the heat and where's the energy when it comes to our young people and the next kind of generation of investors, mortgage owners, retail banking customers? What does that look like, and what are you seeing?
I think,
of course, Berkeley is a special school, but perhaps some signals from there would be helpful.
This is actually the million-dollar question. I mean, I don't think anyone knows what the world looks like. At the moment, what we're seeing is almost like an overwhelming sense of panic. It's not clear when campuses will reopen. It's not clear when the group of graduating seniors, are they going to start work? People have had offers withdrawn. So there's this sense that something is not right, something has to change, but people just don't know. I mean, there's no clarity yet on which way things are going to go.
Mm-hmm. And is there, what was the feeling on campus? Is it one of despair? Is it one of determination? Kind of, what are you sensing? And I think there's, that says something we started, and Jennifer alluded to, we are in as much a crisis around, the structural elements of our economy, but also a lot of that is driven by sentiment, right? So what is your read on what are the college students of today feeling?
A little bit, despair is too strong. I think despair is more my generation, I would say. They are interested in solutions that haven't been developed yet. So they're really interested in decentralized finance, so DeFi. So they're very interested in these technological solutions that will provide financial services in a completely new way. Whether or not any of these DeFi institutions are going to take off and be successful, we don't know. I mean, many of them have only been in operation for a couple of years. But there's this sense that there has to be a slightly different way. And if the pandemic continues and human contact becomes less and less feasible, which is typically our solution to everything is human contact, then it does seem that these decentralized finance solutions are going to be the next thing.
Yeah. Any final thoughts from you, Jennifer, on what we've talked about today?
I was just thinking, based on what Christine was saying, that talk about a generation that, Gen Y, the millennials out of the last financial crisis have an allergy to credit, and now you're getting a next generation coming up, Gen Y. I think is also going to see what happens when you either have a degree with no job or not good job prospects, and being in families that maybe not being able to service their debt. I think we're going to see significant changes in both credit and savings behavior in the long term, just generationally, given the 10 years ago plus now.
Sure. And Jason, any final closing thoughts from you?
I come at it from a research perspective, and I think the sort of big things to watch from me are understanding small businesses, which is not something that research has really been good at. And now more, I almost said now more than ever, and then I just did say, sorry. But I think study of that is really important. I think commercial real estate, I mean, I think there are these big kind of dominoes that we'll need to look at and think about scenarios to understand the future. And not at all to end on a negative note, but I would say that the more pessimistic predictions so far have kind of held. And it's okay to be a little bit dark as we think about how to plan for the future. I think that's important. I think that's an important view to have.
Yeah, thank you. And Susan, I'm not sure if your phone is up and running again. I'll give it a second and see. It doesn't sound like it, but you know, it's an interesting thing you say, Jason. It reminds me of everyone says, you know, plan for the worst but hope for the best, right? I think especially when it comes to the financial services industry, we're seeing things move to a place where we really need to plan for the worst. But if anything that you've said, Christine, about your students or the campus, and Jennifer, what you've said about, you know, how we're going to think about financial services in the future, I think there is some optimism and hope that there's a real restructuring that helps us really move well into the 21st century. So perhaps there is some optimism to look forward to as we kind of work this way through. And the journey is not easy, but perhaps the destination will get to a good place. So I want to thank you all for joining us, especially our panelists, Susan, Jason, Christine, and Jennifer, and those of you on the line. We appreciate your spending the last hour with us. I want to let everyone know on the line that within the next 48 hours you'll get a link to this recording, as well as you'll get a copy of our WTF Finance publication in your email as well. So thank you for your time this afternoon, and stay well, and we'll be in touch. Bye now.
Thank you.